high-risk day trading, not looking at stocks every day, not during the day watching them go up and down. In fact, what I teach people and what I do myself is I spend less than an hour a week. Normally on a Saturday or a Sunday, I scan through the top 100 companies and I make a decision then to buy or sell. And our students have consistently made between 25 to 40% per annum in the market just out of the top 100 companies, very safely. In fact, in the last 2 years, since 2003, they've even made more than that because the market has risen very strongly. There are two ways of analysing stocks. I need to tell you this because one of these works heaps better than the other. Fundamental analysis is what most people have used. In fact, if you read a financial newspaper, if you read financial information in the daily newspaper, if you get reports from fund managers or stockbrokers or financial advisors, most of that information is based on things like assets and liabilities, balance sheets, profit loss statements, long-term projections, company activity. That sort of information is what we call fundamental analysis, trying to determine what the value of the company is. But the value of the company isn't actually what drives the stock price. The value of the company doesn't equal the price the stock trades at. So understanding all about the fundamentals of the company does not necessarily mean you'll make more money out of that particular company. In fact, many times it means you make less. For example, if you bought a residential rental property in the suburbs a few years ago, it's most likely gone up in price. The first thing you might do is get a valuation or an appraisal on the property, wouldn't you? Let's say it's worth $450,000 in today's market. You put it up for auction. 10 people all turn up on auction day to buy the property. What's going to happen to the price? Might go for 460, 470, 500, 520, who knows, depending on how eager they are to buy. But if no one turns up at the auction, you would have to reduce the price below the valuation even to find a buyer. So the value of something is what we think something is worth, but the price is what people's willing to pay for it. So what actually sets the price? Buyers and sellers in the market, isn't it? Or many people say supply and demand is what sets the price. And this is why I say to people, the company activity or what the company does not drive the stock price. That's one of the first things I teach people. Company activity does not drive the stock price. For example, when a company makes a massive profit, what should the price of the stock do? Should go up. What does it do half the time? Over half the time it goes down. You know this one. Telstra. Telstra has made billions of dollars profit per year over the last 5 years and has continued to plummet. Simply because of supply and demand. That's why I suggest that what the company does doesn't actually drive the stock price. Here's another one. News Corp. In 2002, this company announced a $4 billion loss. $4 billion, and it shot up 50%. Now, why do people buy things that are losing money? Doesn't make sense. That's why I suggest that what the company does, and by knowing that, doesn't actually help you to know when to buy or when to sell the stock.
I've done the basic course. I actually did that September last year, and it pointed out a lot of flaws in my trading technique. So I actually used to trade options and shares prior to this, and yeah, I just found it really overwhelming. His insight into the share market is brilliant. Anyone who's looking to get into the share market, I have done some other courses, I've sat some other ones, I've read books. David is by far the best.
And so what we need to do is look at supply and demand, and we call that technical analysis. Supply and demand is simply the study of buyers and sellers using the price movement of the stock. Now, I was very fortunate when I first started to learn about the market. I came across some information by a guy called W.D. Gann. And Gann is one of the most successful traders ever to live. He traded the market from 1902 to 1955 when he died, and it's reputed he made some $50 million US. Starting from nothing, quite a phenomenal feat. And he wrote a book in 1909 called The Truth of the Stock Tape. And in that book he said something quite simple. He said, all a person has to do to make money in the market is identify a trending stock and trade it. Now, as I said before, my background's farming. I spent over half my life on the land. I don't have a degree in financial markets. I've never studied accounting or have a degree in economics. I was simply looking at the market from a common sense perspective. And this made sense. He's saying, work out the direction of price. That's the trend. Work out the direction of price. Is it up? Is it down? And know when to buy and sell based on that. And that's what I want to show you. I spent years studying to find out a simple way of making money in the stock market. And the stock market is not complex. Now, what I learned is a stock never goes straight up or straight down. What happens is more like a bouncing ball, isn't it? And what we notice when a stock's going down, it's like a ball bouncing below a hill or down a hill. It bounces down. In fact, it's called a downtrend. What that means is the peaks, or by definition, the peaks of the bounces are getting lower. So as I said, it's like a ball bouncing down a hill. Very simply, you can draw a line across the tops of those bounces, and that's called a downtrend line. It's like an invisible ceiling. See, the stock goes up, hits it, falls down, goes up, hits it, falls down, and continues to go lower. So it's like a ceiling. Most people don't know that exists. The golden rule is you should never ever own or buy a stock that's trading in a downtrend. See, it's one of the biggest mistakes people make. They go and buy a stock when they think it's cheap. Stock goes from $10 down to $2. People think, wow, let's buy it, it's cheap now. I had someone call me up recently saying, should they buy Telstra? And Telstra's going like that. It's in a massive downtrend. Doesn't mean to say it can't go up tomorrow or next week or next month. But the most dangerous thing you can do is buy stocks that are trending down. All you do is get a ruler and a pencil. Draw a line across the tops of the peaks like that. That's called a downtrend line. Never ever buy or own a stock while it's trading below that. See, what happens, even though it goes up some of the time, when it hits that invisible ceiling, goes up, hits it, falls down, goes, hits it, falls down, it's mathematically proven the stock has up to 9 out of 10 chances of hitting it and falling further down. Hitting it and falling further down. Which means you've only got 1 out of 10 chances of actually making money if you do that. That's a good way to lose. Now, a stock will go from $10 all the way down to $2 and people think, wow, let's buy it because it's cheap. It's only cheap if it goes back up, isn't it? What if it goes down to 2 cents? It was very expensive at $2. Give you a classic example. About 12 months ago, I was running a seminar in Brisbane. And I was sharing this information about trends and not to buy a stock when a stock is in a downtrend. And a middle-aged couple came up to me at the end and said, can you have a look at the chart of Pan Pharmaceutical? Remember the company who was delisted because of malpractice in their products? And I said, well, the company doesn't exist. Why do you want to look at the chart anymore? They said, well, we bought $60,000 worth of them 2 days before it was delisted. Now, if you don't know what that is, that means they lost 60 grand in 2 days. I said, why did you buy the stock for? They said, well, 2 reasons. One is the broker said we should. That's a bad reason. The second reason is it looked cheap. The stock had been going down, it looked cheap, so they bought it. Here's the chart. I showed them the chart, and the stock had been in a downtrend for 2 years before it collapsed. See, shouldn't have owned that stock. They bought it at the wrong time. The stock's in a downtrend. Here's some other stocks. You'll know some of these. Untitled. Untitled was in a downtrend for 2 years before it collapsed. See, by knowing this information, not only does it help you make money, it stops you from making silly mistakes, as I said before. The stock market's a transference of wealth from the ignorant to the well-informed. Those who don't know what they're doing will always give their money to me and other people who know what they're doing. Pretty simple. HIH. Everyone knows this one. This stock was in a downtrend for 4 years, from 1997 to 2001. And I remember watching this stock go down and shaking my head because brokers were recommending clients to buy it all the way through on this decline. Just doesn't make sense. Don't buy a stock that's in a downtrend or trading below a downtrend line. It's too dangerous. Here's a more recent example. This is BHP a short while ago. And you can look at that, anyone can see, a 5-year-old kid can look at that and say, that's not going up, is it? You know, the peaks of the bounces are getting lower. And I simply get a ruler and a pencil, draw a line across